So not what Team Janet wanted to see. NFB hiring was strong. ISM services looked strong in August. Claims are low, still pushing trough levels, and then we get the NFP dud here on the river. So headline NFP 173. Both on NFP and private payrolls, we got the lowest total since March. Net positive revision of plus 44K to June and July, but that doesn't seem like much consolation given that the 73,000 sequential decline here in August. On the growth we have some slides associated with this, and I guess if we could bring up the first slide here, it's our annotated summary table. So you can kind of follow along, and we'll just run down the line here in terms of summarizing the main metrics. I'll summarize the main stuff, what I think is interesting, and then we can get into Q&A from there. So if you're looking at the summary table, looking at the growth numbers, NFP growth decelerated for 6 straight months. As Matt highlighted, we saw peak growth in February, and it's been nothing but slowing since, just given the large number effect. Looks like that peak is in, and higher base to get a higher growth number, you're going to be talking about something like pushing towards 300, 400, 500,000 jobs a month to get back above that 2.35% peak growth rate. It's just not going to happen. Looking across the industry breadth was decent. It was worse sequentially. Manufacturing hiring tanked. And if you look at job mix, so the mix between high wage jobs gained and low wage jobs gained, that also was a bit worse sequentially. So high wage jobs representing just 48% of net gains on the month. Earnings growth flat at plus 2.2% year over year. I guess if there's a little bit of a silver lining, so that's aggregate private sector wage growth up 2.2% year over year. If you look at the non-supervisory and production employment set, which the BLS estimates that's around 80% of the total labor force, up a little bit higher, up 2.4% year over year. So what had been a negative kind of distributional effect where you see the top 20% taking down most of the wage increases and most of the incremental aggregate personal and wage and salary income growth. So a little bit of reversal here in that in the latest month. Going down to the household survey, and again, just kind of 101, the household survey drives the unemployment rate, whereas the establishment survey, BLS surveying actual businesses, drives the headline NFP number. Looking down, household survey up 196, unemployment rate ticking down to 5.1, but the internals on that were pretty weak. So labor force participation was flat sequentially, but you saw the decline in the labor force outpacing the gain in the total employed. So it's down in the narrow range, what the Fed would consider full employment here at 5.1%. But it deserves and needs some context, and the internals inside that number are relatively weak. Other silver lining, I guess, if you look at average hours worked, up a tenth to 34.6 hours per week. So a small positive there. But last month's estimate was downgraded, so the larger takeaway is probably something equivocal. And where the rubber meets the road on all of this is income, right? We're it's a Keynesian consumption economy. What's the read-through to aggregate personal income growth? What's the read-through to aggregate salary and wage income growth? So you had higher wage growth, accelerating wage growth. You had larger hours, but you had a down NFP number. So in aggregate, when we get the personal spending and income numbers for August later in the month, it's going to show something like a flattish aggregate income growth. The trend there has been positive. The flow through to actual, so trend in income growth has been positive. The flow through to actual reported consumption growth has been less so, just because of the rise in the savings rate. So you should see the trend in income growth largely flat sequentially when you see the August numbers come out.